The markets just witnessed one of the most violent swings of the decade. Traders everywhere were shaken out of positions. Portfolios bled red. Accounts that looked healthy last week are now shadows of what they were. But while chaos consumed retail traders, a quiet pattern played out. A pattern that the largest institutions have relied on for years. A pattern that let me turn a potential disaster into one of my best trading weeks of 2025. This is the ICT trick big banks hate. And no, it's not magic. It's not a secret indicator or some overpriced trading robot. It's a precise way of reading price that reveals the intentions of the people who actually move the markets. Today, I'm pulling back the curtain. I'll walk you step by step through the recent crash. I'll show you exactly how smart money set the trap, and I'll explain how a single concept from Inner Circle Trader, ICT, helped me stay one move ahead when almost everyone else got crushed. By the end of this video, you'll see how the very same move that shook retail traders out of their accounts can become the opportunity that sets you free. But before we dive in, a quick reminder, this is not financial advice. I'm sharing educational content so you can learn how price delivery really works. Trading involves risk. You should never trade money you cannot afford to lose. All right, let's decode what really happened. The 2025 market crash is late September 2025. News headlines scream about unexpected inflation spikes. Whispers of more aggressive rate hikes spread across Wall Street. Geopolitical tension is heating up and confidence in the market is beginning to crack. The Dow Jones futures open with heavy selling. The NASDAQ pushes higher for a moment but then whips violently. Gold spikes upward in a flight to safety only to collapse just as quickly. Liquidity evaporates in minutes. From the outside looking in, it feels like chaos. From inside the market, for traders who have studied ICT, it looks like something different. Because price never moves randomly. Every dramatic move, and especially a crash, begins with a story of liquidity. Institutions need liquidity to fill their massive positions. To create liquidity, they need traders on the other side of those trades. And to get that, they need you and me, the retail crowd, to commit in the wrong direction. And that's exactly what we saw in the days leading up to the crash. Across the major indices, equal highs formed. They lined up like a neon sign, stop losses clustered just above. On social media, traders buzzed with excitement. Everyone expected breakouts. It was the perfect bait. Big banks smiled, because those stops would fuel the next big move. The trap SMT divergence and the liquidity grab, here's where the ICT trick truly begins. While retail traders rushed to buy the breakout, a subtle signal flashed for those who knew where to look. SMT divergence. SMT stands for smart money technique. It's a way of comparing correlated markets to detect manipulation. During this crash week, the S&P 500 and NASDAQ both pushed to new highs, but the Dow Jones futures refused to follow. That divergence was the tell. That was the red flag waving in plain sight. Institutions were distributing orders while creating the illusion of strength. They engineered to set up a liquidity hunt above those equal highs. They wanted retail traders to buy the breakout so their sell orders could be filled. And then the trap was sprung, price spiked above the highs, triggering thousands of stop losses and buy orders. In that instant, liquidity flooded in, and just as fast, price reversed violently without mercy, a stop hunt of textbook precision. For the majority, it looked like the breakout failed. For ICT traders, it was confirmation. They saw the footprints. They weren't panicking. They were preparing to strike. The entry order blocks and fair value gaps. Once the stop hunt completed, price left behind a clear footprint, a bearish order block, and a clean imbalance, also called a fair value gap. If you're new, let's slow down here. An order block is the last up candle before a sharp move down, the zone where smart money sold heavily. The fair value gap is the space on the chart where price moved so quickly that it left no overlap between candles, an inefficiency. Together, these areas mark high probability setups. And that's exactly what unfolded in the aftermath of the liquidity grab. Here's how I traded it. As price collapsed from the fake breakout, I didn't chase. Instead, I waited. I let the market retrace back into the order block. Then I watched closely for confirmation. When a candle closed below the low of the fair value gap, that was my signal. On the very next candle open, I entered short. My stop loss was above the high of the order block. My target was the nearest liquidity pool below. The risk toward clean, the setup precise. The outcome, the trade moved quickly into profit. Not because I predicted the crash, not because I trusted some indicator, but because I followed the footprints of smart money. Higher time frame bias. Now here's something crucial. The real power of this trade didn't come just from spotting the setup. It came from aligning with the higher time frame bias. On the daily chart, the market had already rejected a premium array. On the weekly chart, structure screamed distribution. Without that confirmation, the intraday pattern might have been just noise. ICT teaches that the higher time frame gives you the narrative, the lower time frame gives you the entry. When both line up, you're no longer trading against the tide. You're trading in harmony with the flow of institutional money. And that difference is everything. Lessons from the crash. So what did this crash really teach me? First, markets don't crash without warning. They build a narrative. They lure traders into traps. And only when enough liquidity has been created do they deliver the real move. Second, tools like SMT divergence and order blocks aren't just technical concepts. They're windows into how liquidity providers think. They show us the psychology behind price delivery. Third, risk management is everything. Even with the perfect setup, I never risked more than I could afford to lose. I used a simple 1-to-2 risk to reward ratio, because no trade is guaranteed, and discipline is the only thing that keeps you alive when the market moves faster than your reaction time. How you can apply this. Now here's the part you've been waiting for. You don't need a global crash to use this strategy. The same ICT concepts, SMT divergence, liquidity grabs, order blocks, and fair value gaps play out every single week on indices, on forex pairs, on commodities. The process is the same. Mark equal highs and lows. Watch correlated markets for divergences. Wait for the stop hunt. Stalk the retracement. Confirm with the candle close beyond the imbalance. Then enter with a defined stop and a realistic target. This isn't about guessing. It isn't about prediction. It's about precision. It's about reading the story price is telling and positioning yourself alongside the players who actually control the game. The 2025 crash will be remembered for the destruction it left behind. But for those who understood price delivery, it was an opportunity, a chance to trade not with fear but with confidence. A chance to trade not against the tide but with the current. Now you've seen the ICT trick big banks wish you'd ignore. The question is, well, will you use it the next time the market sets the trap? If this breakdown opened your eyes, hit the like button so more traders can see it. And make sure you subscribe because I'll be posting full breakdowns of these trades and even deeper dives into ICT concepts that can completely change the way you view every chart. Stay patient, stay disciplined, and remember price always tells the story if you know how to read it.